Hit it.
It's Friday, July 8th, 2022, episode 186. I'm Patrick Sresna.
And I'm Kevin Muir. This week, we welcome back to the show the original macro man himself, Bloomberg's Cameron Crise. We walk through the current macro environment, exploring the constraints faced by global central banks and what that means for the market, and end with an out-of-the-box surprise you don't want to miss. Then it's time for Talking Charts with Patrick. It's summertime, so most of his crayons have been melted from being left out in the sun, but Patrick managed to cobble together some technical analysis with the dregs.
No problem. And then we end with our segments of No Stupid Questions and Skin in the Game. And folks might even drink some beers along the way. So stick around. We got a great show. Lena, hop on. What beer are we drinking this week?
So this week we are drinking Furnace Room Brewery's Chicken Man Pale Ale.
Nice.
It's like, they blew up a Chicken Man in Philly last night, but this is like a Canadian version.
I think it's based on a real person.
Oh, I think we've done this beer.
We have done this beer.
But I'm gonna read a little blurb here. Yeah. Pedaling his bike around town with his trusty chicken aboard, the Chicken Man, as he was known, has become iconic to the residents of Georgetown. Although his identity is uncertain and his whereabouts unknown, his legend lives on. Make a trip down to Georgetown and ask the locals to tell the tales of how they remember him, or simply enjoy our pale ale in his honor.
Do you know what? One of the guys on my trading desk is from Georgetown. I'm wondering if it's him.
You should ask him about the Chicken Man.
All right, Kev, give us some side effects.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include the FOMC shits and the deadly dumps.
I think it's FOM shits.
Oh, yeah, I guess you're... I did get it a little wrong. All right.
All right, let's get to the interview.
It's our great pleasure to welcome to the show the author of the Macro Man column at Bloomberg, Cameron Crise. Cameron, thanks for joining us.
My pleasure.
It's great to have you, especially, I told the story last time, but I'll tell it again. Your column was partly my inspiration for writing my blog/newsletter, and it's always been a great pleasure of mine to read your stuff. And it was so great when you went to Bloomberg and you kept going and kept doing it. The only thing is, unfortunately, it's not free for everyone. It's only for the Bloomberg subscribers.
Yeah, for better or for worse, it's deemed to be premium content. I'll let the readers be the judge of whether that's an accurate characterization. But it's something that you get with your Bloomberg terminal subscription. So,
well, there you go.
Anyone on the fence about whether you should subscribe to the Bloomberg terminal, listen to this podcast and judge whether the 20 grand or whatever it is
that's right.
worth your while.
That's the thing that'll put you over the edge. Okay, so
exactly.
Let's jump into it because there's lots to talk about the markets. I saw you today on Bloomberg TV, and you were talking about obviously the terrible news with the assassination of former Prime Minister Abe. But one of the things that you said that I thought was very interesting was Bank of Japan has run with an aggressive monetary policy that has passed its sell-by date. What did you mean by that, and what are the implications of that running with this easy policy too long?
Well, I mean, quite simply, we're in an inflationary world, and they've adopted this yield curve control policy where they basically are putting a cap on JGB yields that's basically way below the what would be the fair market price if the private sector were left to buy and sell JGBs. So that's had a couple of impacts. One is it's completely eviscerated the JGB market because guess what? No one wants to buy a 10-year JGB at 25 basis points when they think it should yield 1%,
right,
or 125 basis points. So I mean, like literally, there's no volume in the JGB market. And the secondary impact, obviously, is running a more accommodative monetary policy than circumstances merit naturally leads to currency depreciation, which in ordinary circumstances, you would say, okay, that's not a bad thing for Japan. It's an exporting country, so it'll help maintain a tasty trade surplus. But we're in the midst of perhaps we're even past an extraordinary commodity price boom, and there's been a massive negative shift in Japan's terms of trade. So what the weakening of the yen has done is it's made energy imports extraordinarily expensive for the country, and obviously Japan doesn't have any domestic energy resources, so all the energy they consume has to be imported, and it's become much more expensive. And so the weakness of the yen has actually exacerbated this this problem of high energy costs, and it's been a real detriment to the economy, contrary to what we've kind of all grown up believing.
Now, wouldn't you think that given this weakness in the yen, combined with the massive move in commodities, that we would be experiencing more inflation in Japan than we've had?
Yeah, I mean, you might think so. I mean, on a relative basis, it's a lot lower than it is in the rest of the world. On a relative basis to Japan's own history, it's still quite elevated. Yeah, but yes, I mean, the short answer is you would normally expect it to have had more of an impact. And I'll be honest with you, I'm not quite sure because I haven't really looked into it in the requisite detail as to why that hasn't happened. Obviously, we know the longer term issues of the demographic challenges and the shrinking population, shrinking workforce, shrinking capacity to purchase. So, I mean, it does not seem reasonable that you're going to have the same sort of demand component to inflation that you've had elsewhere, because you haven't had quite the fiscal windfall, and you have a weaker consumer base anyway, given the age of Japan's population.
Now, when we see this, the Bank of Japan pushing up against the willingness to raise rates, we're also seeing the same kind of feeling, or not to the same extent, but the same direction from the ECB. What do you make from their reluctance to raise rates and to follow the Fed and other central banks higher?
Well, I wouldn't characterize it as reluctance. I mean, they're going to be hiking rates in a couple of weeks. Which is something that I think if you'd asked 100 people 6 months ago, will the ECB be hiking rates this year? You would have had 100 people saying no way. So they have accelerated the timetable for policy normalization with relative alacrity. The problem for the ECB is it's almost kind of like a game theory problem, because there's no optimal policy. There's literally not an optimal policy, because they've got essentially two main policy goals. One is to maintain price stability. That would obviously argue for substantially tighter monetary policy. But the second, which wasn't part of their formal constitution or their formal directive when the ECB was created, but has become clearly an important de facto goal, is to maintain the integrity of the pan-European bond market, in the sense of ensuring that there's a lid on spreads in the periphery. Italy being obviously the most vulnerable there, and clearly there's a sense that the more aggressively they hike rates, the more pressure they're going to apply, upward pressure that they're going to apply to sovereign spreads. So, in a sense, any progress that they make on the inflation front represents a headwind to achieving the bond market stability mandate. And sort of the waffly solution is to talk about this, this sort of magic wand tool that they thought up a name for, but not the details about, and kind of hope it's kind of like you put your hand in your pocket and you stick your thumb up and your index finger out, and it looks like some sort of gun, firearm or something, and they're pointing at the market and saying, well, don't make me use this. When they did a similar thing under Draghi with the OMT, which was essentially QE without calling it QE, and they never had to use it because the market respected respected the threat. Will that be the case this time around? I mean, I guess we'll have to wait and see. But I think the challenge for the ECB is what it's been for the last dozen years, is they're managing a monetary union that doesn't have a concomitant fiscal union. And in times of stress, you get these sort of inconsistencies. And it makes it very difficult to say what the optimal policy is.
But, I'm going to push back a little bit in terms of the idea that the ECB is actually even the tiniest bit aggressive, because if we look at the policy, the currency and what's happened as they've dragged their feet, because on a relative basis, both them and Japan have been much slower than, let's say, the Bank of England or Bank of Canada, Australia, all these other places that have been following the Fed higher, and yet these two haven't. And so what we've experienced is this massive weakness in their currencies. And you've kind of touched on it in terms of they're actually making their inflation problems worse by not raising rates. And I almost think in a perverse way that they need to raise rates to help their economy.
Yeah, I mean, to a degree, but again, I mean, you can explain over the last, whatever you want to call it, dozen years, you can explain a lot of the performance of the euro with a simple two-factor model. One is some sort of interest rate differential component, which is what you're alluding to, but the second, again, is the spread component, say the Boon BTP spread. And is it beneficial for the eurozone in aggregate if they jack rates up by 100 basis points or 150 basis points like tomorrow, hit domestic demand on the one hand, but also massively put pressure on Italian fixed income? Is that currency positive? I'm not sure that it is. And there's the other issue where Europe is different from the U.S. and Canada and Australia insofar as they have relied on Russia a lot more for their energy needs. And obviously the squeeze in European energy prices caused by the sanctions on Russia as a result of the war have had a very deleterious impact on the inflation numbers and on domestic purchasing power. But I mean, I don't think anyone thinks that the price of natural gas in Europe has anything to do with the cost of money, surely.
Right. No, a completely different kind of issue there. But in terms of thinking this through, if we have the Japanese, the BOJ, my first question where I said that they're dragging their heels and they're continuing to do kind of an easy monetary policy that's past its sell-by date. And Europe also does the same because they're worried about spreads, Italian Bund spreads. Could we have a situation where we almost have the dollar going kind of straight up and that causes a financial crisis? Is that something that worries you?
Well, we're seeing that already, right? I mean, we've observed. I mean, the DXY has been on a rocket ship this year, and you're already seeing some of the fallout in, I guess, what you'd call frontier markets. In terms of, I think Sri Lanka defaulted on their external debt. Other weak external borrowers are at least. I wouldn't say they're threatening, but there's certainly a legitimate threat, I think, of distress on that front as well. And yeah, I mean, the problem, the whole currency war thing is pretty funny, isn't it? Because, a dozen years ago, everyone was moaning about their currencies were too strong. Now they're moaning that the currencies are too weak. Unlike in, say, 2015, 2016, when the Fed really dialed down its intended tightening because they were worried about the impact of the strong dollar. I mean, this time around, they're certainly not going to complain about the strong dollar. Eventually, it might lead to a bit less tightening than they otherwise would do if it goes sort of even more parabolic than it has already. But right now, the U.S. at least can sort of take comfort in the fact that the dollar has been a boon in that regard. And arguably, if the dollar strengthens substantially, and that puts more downward pressure on commodity prices generally, well, given the relative volatility of currencies and commodities, you could actually see a scenario where dollar strength actually does make energy prices, or maybe not energy is a bad example given the Russian situation, but makes the price of industrial commodities cheaper for everyone. If they go down by 20% and say the euro goes down by another 5%, well, then all of a sudden copper is 15% cheaper in euro terms. That's not a bad thing.
I hear you. One of the columns you wrote recently was you said, I used to say that current accounts don't matter until they matter. And then that's all that matters. What did you mean by that? And kind of why don't we explore that in the context of these different currency moves we're seeing?
Yeah, well, okay. If you read sort of a textbook on fundamentals of exchange rate determination, one of the primary factors that's cited is the external accounts. All else being equal, a country that runs a trade surplus will tend to see its currency appreciate. A country that runs a trade deficit will tend to see its currency depreciate. In practice, the world's a lot more complicated than that. Certainly, the U.S. Has run a chronic current account deficit, but it's hard to know which is the chicken and which is the egg. In the sense of, as the world's reserve currency, there is tremendous demand globally for U.S. assets, U.S. financial assets. And so if the rest of the world throws money at the U.S., essentially to buy treasuries and other financial assets, and the U.S. runs a capital account surplus, then kind of by definition, they need to run a current account deficit. And so using that as using a signal of, the U.S. runs a current account deficit, therefore the dollar needs to appreciate, it doesn't always work. In fact, it works a lot less often than it doesn't work. But sometimes it does work, which sounds like I'm waffling here, but that's, welcome to foreign exchange.
Yeah.
Right.
The key is to figure out what the market cares about today.
Yeah, exactly. But typically what you find is that the market generally doesn't care. I mean, emerging markets are slightly different, but we're talking developed markets here. The markets generally don't do a marginal trade, or currency speculators typically will not do a marginal trade based on external balances. But there are times when that's what matters. And this, I think, is one of those times. And one of the reasons for that, which is something I've touched on this week in my stuff I've written, is that it's difficult to appreciate unless you actually look just how much the U.S. has sort of re-engineered itself. When oil was at its highs sort of 15 years ago, the U.S. Trade balance in petroleum goods was a deficit of $30+ billion a month. The U.S. actually now runs a tiny surplus in petroleum because of the investments made in the fracking and other stuff. Obviously, the U.S. is a big exporter of agricultural commodities. And so what we've observed this year is that even as the terms of trade have deteriorated markedly in Europe and in Japan, the U.S. terms of trade have appreciated or improved quite a bit. And I think that explains a lot of that, as well as some of the interest rate stuff. But that has been a notable feature of the support that the dollar has been given. And it's a big change because from the inception of the euro, basically up until almost the start of the pandemic, the U.S. terms of trade were very, very similar to that of Europe, but that's no longer the case. And so this terms of trade is essentially one aspect of this idea of trade balances. Now, it is the case that the U.S. is running a ginormous trade deficit. So you could argue, well, okay, that would illustrate that actually this stuff doesn't actually matter. But if you consider that a lot of the world's oil exporters and producers are essentially pegged to the dollar, so they're essentially in the dollar block, then if you add essentially their trade accounts to the U.S. trade accounts, I think it makes a lot more sense.
I get it. So you're arguing that basically Europe and Japan, the reason for their currency depreciation is because of the terms of trade getting so much worse because of oil.
Oil, and in the case of Europe in particular, natural gas.
Right.
Okay. The U.S. is a big natural gas producer, as is I think Canada produces quite a bit. I would assume they do. Now that's obviously not quite as easy to ship to and fro as crude oil is, but I think the U.S. is now exporting some LNG to Europe, even though there isn't exactly the price of U.S. natural gas and European natural gas. It's never going to be perfectly fungible, so the prices are never going to be equivalent. But certainly, it's something that is a big benefit to the U.S.
Now, we've had this monster move in the dollar. We have people calling for parity in Europe, or even 95 cents, and it finally seems like the tone might have changed. Whereas most people used to be dollar negative, there's all of a sudden a lot of dollar bulls. I was wondering, what would it take for you to, or what would you imagine could be the what would trigger you getting more bearish on the U.S. dollar? Or assuming that it was going to not the rise was going to slow down or even decline?
Well, given what we've just said, I mean, to be sort of logically consistent, if there is a substantial downturn in commodity prices, that should be dollar negative under this framework.
Right.
If it happens via some sort of resolution to the Ukraine conflict, that on a broad basis would be seen as Euro DXY, Euro positive, which is DXY negative, and that would probably radiate across a number of different currencies. Obviously, that's a political question rather than an economic or policy question.
Right.
And so, in a sense, it's out of the hands of the stuff that we can trade and the stuff that we the policymakers that we follow. I guess there's one policymaker in Moscow that matters on that front.
But
I don't think he's going to listen without wishing to cast aspersions on your listenership. I don't think he's among the Market Huddle listeners.
I'm pretty sure he might want to figure out what the beer of the week is. You never know. So Cameron, if nothing were to change and oil and commodities would actually start to rally again, would you therefore assume that the dollar would also be forced to or would likely go higher in the same vein, keeping kind of it all the same?
Well, I think you'd have to say so. Right. Because that would just present more of a terms of trade challenge for those currencies that have faced a terms of trade challenge thus far this year. It would also probably defer the onset of a turn from the Fed.
Yes. Okay. So let's talk about that, because I would completely agree. First of all, let's just understand where you stand in terms of interpreting the Fed's moves, how it's evolved. Why don't you tell me what you think they've gotten right and wrong over the last year and how this has evolved?
Well, what they've gotten right is just about nothing. What they've gotten wrong is just about everything.
Okay.
So that's a pretty short conversation.
Okay, so why don't you tell me? So first of all, were they were obviously wrong about inflation being transitory.
Yes,
and they were assuming that it was going to look a lot more like Ben Bernanke's. What was it, 2014 or 13 when we had that spike to 3% and then it came back in.
But Kevin, if I could interject,
yep.
The reasons they were wrong were completely forecastable and understandable.
Okay,
they were viewing inflation last year almost exclusively through the prism of supply. Just after we'd had the biggest fiscal money drop in absolute terms in U.S. history, obviously, and as a percentage of GDP since the Second World War.
Yes, completely agree.
Now, if every person in America wakes up and finds a pot of gold, under their bed.
Yeah.
What do you think is going to happen to prices?
They're going to
Well,
go
the
up.
same thing that happened in Spain in the 16th century when they were exploiting gold out of South America. Massive inflation, and that's essentially tantamount to what's happened in the U.S. in particular after the COVID the three-headed COVID stimulus, of the CARES Act, and then the one in late 2020, and then the one in early last year. Everyone ended up with a boatload of money, which increased spending power.
Okay.
And if you look at personal consumption expenditures, they went ballistic. So the idea that it was just a supply issue was obvious nonsense.
So Cameron, I'm going to jump in here because I want to, before you go on to the next point, I want to talk about this a little bit further because I completely agree. And one of the things that pisses me off is the MMT folks. They're all trying now to blame it on the supply side. And yes, I agree. Supply has been curtailed. It's obviously not 100% demand. But at the end of the day, their whole argument was always, you can always make inflation, and it's just a matter of spending that money into existence or taxing less, basically fiscal stimulus, and the real resource constraint will show up as inflation. So why are we not well, I know the answer to this, but it just frustrates me that people are not just admitting that we spent too much and that let's face it, the second CARES Act was not needed.
Well, as I'm sure you've observed in your many years of participating in financial markets specifically and in life more generally, it is a very tiny percentage of the population, either in finance or in the world at large, that will put their hand up and say, you know what, I screwed up, I got it wrong. I would include our fiscally facile friends in that camp. And I will say, to Jerome Powell's credit, he came basically as close as you'll ever hear a central banker saying, yeah, we blew it. When he, I think in maybe February or March,
right,
he unveiled in retrospect, we probably should have gone earlier,
right,
line, which was an admission that they blew it. So in terms of the Fed this year, they've done what I would assume any listener of this podcast who's traded in financial markets has done at one point, at least in their career. They've executed a stop and reverse order.
And then they're short and they're scrambling for anything they can. They're grabbing all the offers.
They were adopting the same gently tiptoe through the tulips monetary policy that has worked, or that whether it's worked or not, I think you can probably debate. But that they've been adopted certainly since the financial crisis, and arguably since the end of the .com bubble. But in fairness, once they decided that the world had changed, they did change their strategy pretty aggressively.
Okay, so let's talk
from that perspective. They do deserve some credit,
right? So now let's talk about what might happen as this execution of the strategy continues. Now, first of all, the market is assuming that they're going to raise another 75, 50, and then basically that'll be it. The economy will roll over, and next thing you know, next year we're going to actually be cutting rates. Do you think that is the most likely outcome?
In terms of the magnitude and timing, I mean, the range of possible outcomes is so wide that is it the most likely? Is it the center of the distribution? Is it the modal distribution? I don't know.
Okay, well, how about this? Do you think the economy will be rolling over and to the point where they're cutting next year?
I think there's a decent chance in the second half of the year. I mean, let's put it this way: the broad stroke thesis that inflation is so high that they're forced to react aggressively enough that the economy eventually tilts into recession, I think is completely reasonable. which is why you don't. And which is why the whole idea of, oh yeah, we want inflation to go up a lot because we know how to control it, was always nonsense.
Okay, so but if we get a situation where the Fed is raising rates, there is going to eventually be pushback in terms of the economy, and even more so, eventually we might have a situation where the stock markets start to really complain. Are you worried about that? Do you think the Fed is gonna be the, they always say that every economy gets killed by the Fed and by raising rates, and often a lot of times they're the instigators of crashes or too tight a policy. Is that become a risk that you're really worried about?
Well, I would say this. I would say that they are, and probably correctly, more concerned about the negative income shock that inflation has delivered to sort of the bottom half of the income and wealth spectrum than they are concerned about rich people being a little less rich because the stock market's gone down, or God forbid that the whole crypto circus, the tent sort of loses a few poles and falls in on itself. If anything, that could be a feature rather than a bug of policy if people actually go out and start looking for work. Because one of the issues with the economy at the moment is that the labor force still hasn't recovered to its pre-COVID COVID levels. And while it is certainly reasonable and indeed likely that demand for labor will wane as rates keep going up, the rate hikes will be able to end earlier if the labor force sees more entrants. And if that happens, then perhaps they might be able to pull off the fabled soft landing. I think generally speaking, it is reasonable to think that whatever recession that we get will probably be mild, for the simple reason that household balance sheets are in pretty good shape in aggregate.
And labor is so tight still.
Yeah, but I mean, the presumption here is that pretty much by definition, a recession entails a weakening and a deterioration of the labor market. But if you look at sort of cash balances of U.S. households, it's 75% of GDP, which is sort of way, way, way above any level in history before COVID. So people are sitting on a ton of cash. Now, I saw a chart secondhand. I think it was from Bank of America. That sort of broke down on an index basis, like checking account balances by income cohort.
Oh, yeah. I think I saw that same one. Yep.
And, all the income cohorts, people making more than 100 grand, people making 50 to 100 grand, and people making less than 50 grand, had checking account balances way, way, way above where they were before COVID. And I think, if I have memory serves, that the lowest income cohort had, relatively speaking, the highest checking account balance relative to pre-COVID levels. So from that perspective, that's a comfortable foundation, if you will, for an economic slowdown, because it should mitigate the length and severity of the drawdown. Unlike, say, the GFC, obviously, where people were sitting on a mountain, a veritable Everest of sort of mortgage debt and household debt more generally that they had to work through if they were able to.
So now the Eurodollar and the futures, like the yield curves in general, have this weird kink where they have this expected rate hikes from the Fed, and then a year from now they have the decline, which you could argue that they're in the process of pricing in at least an economic slowdown in 2023. And you said that it's likely that that's what you believe will occur then too. Do you think that the stock market has also priced in that reasonable expectation?
No.
I
think the stock market weakness that we've observed to date has been an interest rate issue, if you will. So interest rates have adjusted up, so the PE multiple has adjusted down, which is what you would expect, right? As the PE multiple adjusting down means that the earnings yield, i.e., how many dollars of, or how many cents, I should say, of earnings you get for every dollar of equity investment that you make. That should be broadly, not perfectly, but broadly correlated with the risk-free yield. Risk-free in parentheses or commas, I guess. If you're willing to dispense with inflation risk, right? So the weakness we've observed thus far has been about multiple contraction.
Okay.
What we haven't seen yet is the contraction in expected earnings, which I would expect to start, sort of imminently. It's already started a little bit. There's been a couple of little announcements here and there and what have you. But broadly speaking, we're still at the peak expectation for 2022 and 2023 earnings, not only for the S&P, but for other markets around the world as well. And surely the risk is, if we do end up with a recession, that those earnings fall in absolute sense, rather than growing as is currently expected, because unsurprisingly, corporate earnings tend to have a pretty high beta to the economic cycle. And so I would expect a second round of equity weakness that is a function of declining earnings expectations. And that's probably going to be the sort of the cathartic decline.
Okay, in terms of, let's imagine that the fabled soft landing is achieved. Let's just say that commodities start going sideways. All of a sudden, the Fed doesn't need to be quite as aggressive. The consumer ends up being more resilient than everyone thinks. Next thing we know, we have interest at the front end is 3.5%, and the economy is still chugging along. And it looks like all of a sudden the curve changes, and there's still the strength lasts longer than we think. What would be your expectation about the types of sectors that you should look to outperform in this period? Like, we've had this decline in growth for the past 3 months, 4 months, that seems to have gone the other way over the last week. Is the fact that it's rallying again a sign that that market, part of the market, thinks that we're about to go down in the recession and the moribund growth is coming back? Or do you think that if we do get kind of a muddle through economy, that the old leaders of tech and all those things will take off once again?
I'm a little skeptical that we'll get the sort of technology move that we saw, well, really after for the decade, the dozen years or the 11 years, whatever the number is, after the GFC. Because in that scenario that you've just sketched out, I think any rate cuts that emerge from a soft landing will be relatively modest.
Okay.
Now, technology stocks are sort of the famous infinite maturity asset, right?
Right.
They do best when rates are slashed to the absolute bone. Getting rates down to 2.5 or 2.75 or wherever we end up landing, on the margin it's better than 3.5, but it ain't the same as 25 basis points with a promise of zero. And QE to boot, right? So I would be a little surprised if technology roars to the same degree that it did before.
Okay. Do you have any ideas of what would roar, or would it be just a return of a more stable across the board market?
Well, I mean, I know this is cliched. I mean, I would like to think that we live in a world where sort of the whole value cohort does do okay,
right?
For more than a millisecond. I think a global soft landing would probably be pretty good for EM. I think
that's interesting. Yeah.
I think if the Russian situation resolves itself, then there's almost certainly going to be value in Europe. But those are big ifs. All of these are very, very big ifs.
Let's go and jump into that EM a little bit. if we did have a muddle through situation, and let's just assume that the Russian situation is a stalemate that gets no worse, no better, what would potentially be some of the types of countries that would do better in that environment?
Well, everyone loves China, right? And the Chinese have sort of given you the nudge, nudge, wink, wink. Because apparently they've stopped putting the kibosh on domestic technology companies. And B, we're now starting to get the sort of the stimulus rumblings. There was the announcement or the headlines this week about the whatever it is, $220 billion of local government borrowing that can be unleashed,
right?
Which would probably end up in the same place it always does, in commodities and infrastructure spending and what have you. But I think people are predisposed to look at China favorably from a valuation perspective, because it was such a toxic nuclear waste dump of a market to invest in for certainly for outsiders for much of the last sort of 18 months. That I think people are and particularly once the COVID lockdowns end, I think there's this idea that you'll get sort of the unleashed, pent up demand and what have you.
Okay.
So China's an obvious one. Again, it kind of depends on what happens with commodities, right? If commodities remain relatively elevated, then that's sort of good for the Brazils of the world. If commodity prices, particularly energy, retreat, that's better for, I guess, the Indias of the world, right?
Okay. Now, one of the other things before I want to make sure that we hit on is you wrote a little kind of blurb about the move, which is the VIX of the fixed income market. And it's recently hit its its high, like its GFC, maybe the 2020 high, the COVID high at the very least. And I think it was on par with the GFC high. I was wondering what you are thinking is occurring there. And is it really as elevated and as big a deal as it looks at first blush?
Okay, so it didn't quite reach its COVID high, and it's nowhere near its GFC high.
Okay, there we go.
It has gone up a lot.
Okay.
It's not entirely equivalent to the VIX insofar as the VIX looks at a range of strike prices,
right?
Whereas the move is at the money. It's basically at the money 1 month options on the twos, fives, 10s, and 30s. I think.
I didn't realize that.
It's kind of duration weighted or something.
Okay.
So I think 10s have the highest weighting in there.
Okay.
It's like 0.2, 0.2, 0.4, 0.2, I think. So A, it's at the money, not wings.
Yep.
And B, it's weighted across the curve. 1 month swaptions. So it's not totally like for like, but I mean, it's certainly understandable why it's gone up, because there's a heck of a lot of uncertainty about the fate of the economy and therefore the fate of policy. We don't know what inflation is going to be doing. We might have an idea, but I don't think anyone was forecasting inflation on an 8 handle, by the middle of the year. I mean, I thought I was pretty hawked up on inflation. I didn't think we'd be anywhere near these levels. Granted, the whole Russia thing is partially culpable for that.
Right.
But there's tremendous uncertainty about inflation, tremendous uncertainty about growth, tremendous uncertainty about policy. I mean, which of those says that volatility should be low? Obviously none, right? And we're coming from a base of the all-time low in the MOVE index just before the election in 2020. So, I think I can't remember if we talked about this last time, but the best way to think about volatility is like a spring, right? And the longer and the harder that you coil the spring, the more potential energy is in it, if you ever took a physics class. And then once you sort of take your hand away and the spring uncoils, well, a tremendous amount of potential energy then transmits into a tremendous amount of kinetic energy, which is essentially what we're seeing now. And so to get the fixed income volatility, whether you look at the move or look at euro dollar realized or implied volatility, however you want to articulate it, it's telling us that there's a tremendous amount of uncertainty out there, which I think is just something that we probably should have known or should know through other avenues as well.
Right. I would argue that the underlying economic volatility has also gone way up, and it makes sense that the fixed income volatility is up. One of the things that I find interesting is the fact that although fixed income vol is through the roof and stock market is elevated, it's only been over the last few months that FX vol has gone up. And I think back to your spring kind of analogy, and I wonder, is the kind of one of the themes or one of the interesting things to play for the rest of 2022 and maybe even 2023 is, are we going to see eventual moves in FX vol similar to what we're seeing today in move vol?
I'm not sure because FX volatility, once it hits some sort of extreme, typically engenders a policy reaction because there are knock-on effects, right? Obviously, if the euro goes to 80, that becomes very problematic for Europe in terms of inflation, in terms of stability, and whatever. And not only is interest rate policy an option, but obviously FX intervention also becomes an option. We saw FX intervention to buy the euro when it was at 85 20 years ago. So that I'm not saying that they're going to intervene below parity, but clearly that becomes eventually sort of one of those policies that's behind glass. Only break in case of emergency. But it's certainly a possibility, I suppose.
It's been a long time since we've seen intervention. I remember the old yen interventions. And I've always said that, like, on a trading desk, that's got to be the greatest job in the world, to get the call from the Bank of Japan and asking where you are on a couple of yards or whatever, and you have to give them a price.
Yeah.
Like, that's 1.5 handles, big figures away, and you're like, how much am I gonna be left with? Like, those were the fun days when that happens.
Yeah, I mean, when FX was the Wild West. Now all the guys that were on spot desk then are now trading crypto. That's because that's the Wild West.
Okay,
I mean, seriously.
So let's talk a little bit about crypto. We obviously have seen the collapse over the last 6 months. Do we get a bounce here, or is this a situation where you're just going to keep bleeding lower and lower and lower just because so many people are offside?
Well, I think people have been looking at 20K in Bitcoin as some sort of important threshold. And guess what? We've been hugging 20K for the last couple of weeks, last few weeks. I think crypto is fascinating because it's managed to make, 300 years of mistakes all in the span of a dozen years. When was the Satoshi white paper? 2009? No, a baker's dozen years. I mean, the sort of the pyramid scheme of cross ownership and what have you is truly breathtaking, and it certainly presents an ongoing risk as far as I'm concerned, albeit with the caveat that I am not intimately familiar with every cross holding of every crypto institution. But from 40,000 feet, it looks like there are probably still quite a bit of skeletons in a number of closets. So, listen, I think if the Fed continues to put rates up, which does seem like a reasonable proposition for the next couple of quarters at least, that's going to continue to apply pressure on the crypto space, I think, because ultimately crypto is just a hedge against zero rates. I mean, I think that's become kind of more evident over the last few years. It's a thought that I've had. My friend Brent Donnelly, you must know Brent.
You're Canadian. Brent's been on our show. I'm a big fan.
Yeah, all you Canadian guys know each other, right? He made the point in a piece a week or two ago and he's much more attuned to crypto and the intricacies of that market than I am. So it's kind of encouraging that my sort of sense, my sense was sort of validated by his comment. So if you're talking about a zero interest rate hedge and interest rates aren't zero and continue to move away from zero, I think the null hypothesis has got to be that there's further weakness in store, particularly given the sort of structural issues involved with that market in terms of cross holdings and whatever, and hidden leverage. Hidden leverage is always a danger, and I think that market in particular is rife with it.
I've been saying this for a while because I always say that people kind of crises are never something that people have hedges against, them happening, because if they did, they wouldn't occur. It's always something that nobody expects, and without leverage, without borrowing, you don't get the real panic sell-offs. You don't get the real kind of unwinds, the nasty unwinds. And they've always said, I've heard these crypto people say things to the nature of, well, the dollar is a fiat-backed system that's not really backed by anything. And I said, yes, you're absolutely correct. And they kind of compare it to its own currency. And I said, yeah, but one of the things that they all forget is that in the early days of the dollar, when they could be created, by banks in like the 1800s, there was all these private banks creating all sorts of dollars and credit. And in the 19...
but Kev, none of them were 16 or 8-bit apes.
Whatever.
That's the important difference. That's why crypto is so much better.
Okay, but the point that I always make is that in the 20s, we had a situation where I don't know the numbers, but it was something like there was 30,000 private banks and it went down to 5,000. There was some crazy number like that. And it was a process of them going bankrupt because they had created credit, and they're on the other side. There was nobody to help them out. And the Federal Reserve is there, the government is there on the dollar. And so when we get into a GFC type situation, they can create dollars. But who's going to make it in this situation? There's just not enough seats to go around. So I've always said I don't know how much kind of leverage there is in the system, but that was always the question I always asked my guests: how much leverage is in the system? Because that was what you wanted to know about how bad it could possibly get.
Yeah, I think you bring up a good point. What crypto does not have is a lender of last resort, right? That the Luna people thought they had a lender of last resort, which was themselves, and it turned out not to be the case, right? And the whole raison d'etre why the Fed was created, Federal Reserve System was created, was a reaction against the panic of 1907,
right?
Which itself was just the one of many deflationary financial panics that struck the United States periodically. It was roughly every 20 years or so. You would get these deflationary panics in this environment, this sort of Wild West environment that you referred to, of no central monetary authority, and sort of everyone could kind of create their own money, bills of exchange, and what have you. And it was deemed to be a decidedly suboptimal way to do things. Now, is the Federal Reserve System optimal? Yeah, probably not. But and obviously, as discussed earlier, the Fed has certainly not turned out to be infallible and has made mistakes, and we still have the economic cycle. But as bad as the GFC was, that was sort of business as usual, prior to the Federal Reserve. That's what downturns look like. They look like the GFC.
That's a great point. I never thought about that. That was more par for the course back then.
Yeah.
All right. Okay. So Cameron, it's getting late. I'm going to ask you, we've already asked you the regular 3 questions. We're going to sneak out the 2 that I really love. The first being the Byron Wien. Byron Wien used to produce his yearly surprises. And what he defined a surprise was something that he thought the market had a less than 1/3 chance of occurring, yet he believed himself that it was a better than greater than 50-50 chance of it happening. Do you have a Byron Wien surprise for the next year for us?
By next year, I will assume you mean calendar year 2023.
Well, you can do whatever you want. You define the parameters.
I'm in the media now, and I've learned that the trick in the media is you don't, when dealing with the media, you answer the question you want to answer, not the question that you were asked.
Okay, go for it.
So I'm gonna use calendar year 2023 because I'm incapable of thinking June to June or July to July.
Okay.
And I am going to say that the ECB cuts rates next year.
Really?
Well, let's put it this way. The Fed is priced for whatever they're priced for, sort of 60 basis points of cuts next year. The ECB, on the other hand, is priced for about 50 basis points of hikes. Now, in what world where the Fed is cutting rates is the ECB hiking rates?
Okay. Interesting. So you think that they'll get one or two hikes in and then they'll be cutting with the Fed?
Yeah, let's put it this way. The path that everyone expects for the Fed, I think, is probably more likely for the ECB.
That's a great... listen, you really picked a Byron Wayne surprise because I would argue that the market has a way less than 1/3 chance of that occurring. So that's a great... you're doing a great honor by picking that one. Okay, the next one is... the Don Cox. And Don Cox was a famous Canadian strategist, and he used to talk about investing not on what's on page 1 today, but what's on page 16 on its way to page 1 tomorrow. Do you have a Don Cox pick for us?
Well, I have to offer the usual Bloomberg disclaimer that I cannot provide investment advice or explicit trade recommendations. What I will say, however, is that it has by now become fairly common knowledge that the U.S. housing market is slowing pretty dramatically. Prices have not come lower, but activity has certainly waned. Incidentally, that's exactly the pattern you see with commercial real estate. Typically, is you don't see prices collapse; you just see there's no trades.
Right.
And one of the features of commercial real estate is typically that there's a shortage of supply, which I think is also what's driving the U.S. residential housing market, is that there's still very, very little supply. So as demand wanes, stuff quits trading rather than sellers kind of panicking and hitting the bid or offering through the bid, which is what we saw after the GFC. Right. Anyhow, that's kind of a long-winded preface to the observation that mortgage spreads are very, very wide relative to history, and like mortgage REITs have gotten demolished on the housing slowdown story. But the nice thing is that the move up in mortgage rates was kind of so fast that as mortgage rates decline, I don't think there's much prepayment risk, for the first 100, 150 basis points, because it happened so fast that there wasn't really many mortgages taken out at 4.5%, right? Because we went from kind of 3.5 to 5.5 in the blink of an eye. So I would think that the owners of mortgage-backed securities, like mortgage REITs, will probably do pretty well.
Right.
At some point, and I guess that's as far as I can go.
And I guess that dovetails very nicely into your idea that the move is at the all-time high, or at the recent move, like the high for this past kind of move in the actual volatility. And for those who don't know, mortgage backs are traditionally short volatility.
Yes.
Right. So a decline, a settling down of volatility in the fixed income market would also benefit mortgage-backed securities. Okay.
Well, I think more broadly, if you adopt the idea that you're supposed to be buying when they're crying and selling when they're yelling.
Yep.
Well, I think there's a lot of crying now about the housing market, given the move in mortgage rates, and certainly a lot of owners of mortgage rates, or owners of MBS, agency MBS, have gotten bashed. So that's a place I think that's probably worth looking at.
That's great. Well, thanks for that. Now, before we let you go, I'm just reading through some of your columns here, and I see that you mentioned the Tour de France. Are you a big rider?
I do like to ride, yeah.
And do you watch as well?
I do watch.
Did you watch today? I actually, one of the guys on my desk was watching it, so I watched today.
It was absolutely fantastic.
And
I mean, I would prefer if Pogacar didn't win, but for listeners, this was stage 7 up la super planche de Belleville.
Okay.
And two-time reigning champion Tadej Pogacar has just won a second stage in a row, but it was fascinating. It's
24. The incline is 24 degrees, which I know a lot of people think that doesn't sound that hard, but 24 degrees is a lot.
Well, technically it's 24%, not 24 degrees.
Oh, sorry.
Is
that sorry? Well, there you go. You say I'm getting it wrong already.
It's actually slightly less than 24 degrees, I believe.
Okay.
But it's still, yeah. I mean, it's basically the steepest thing you can do. It's brutal.
Well, one of the funniest parts is I said I kind of looked away from the screen for a little bit, then went back and looked again, and I said, "Oh, look, they're going downhill now because they were going so much faster." And my buddy says, "No, that's just not as steep anymore."
Yeah. Well, there's a guy from Intermarché who finished about 10th, I think. I don't know if he had a mechanical or what, but he was running his bike across the finish line. So it's like, it looked like it was just too steep for him. So he figured, I'm going to be faster hopping off and pushing it like a kid rather than pedaling through, which is,
now, do you just do road biking, or do you also do some mountain biking?
No, I like my ribs as intact. So I only do road cycling.
Why do you say that? You think that you're prone to breaking ribs if you go off into the woods?
Well, I mean, to be a good mountain biker, you need to be good. You need to be a good bike handler. And I've literally never done mountain biking. And I think, as someone of what I'll charitably call veteran years, I'm not sure if picking up mountain biking with terrible bike handling skills with an age that starts on a 5-handle is an ideal way to maintain the integrity of my ribcage.
Well, you know what? You're probably right there, Cameron, because what happened with me is I mountain biked when I was in my 30s, and then when COVID hit, my son, who was 15 or 14 at the time, I was like, what am I going to do with him? Like, he's a 14-year-old. I got to get him out and do some exercise. I said, okay, we're going to start mountain biking again. And I think I went 3 months before I broke my hand.
Yeah.
And then a year later, I gave myself a concussion. It's been a little bit of a shit show.
So I've got a buddy who there's a famous mountain bike race in Colorado called the Leadville 100.
Yep. Actually, one of our guests, Morris Sachs, he's actually finished it.
Awesome. Yeah. So I have a buddy who was going to do it a few years ago, a road cyclist. So he bought himself a mountain bike for, I don't know, like $7,000 or something. Some nice Cannondale mountain bike. I think on his 3rd or his 4th ride, he fell over, broke about 3 ribs. And I don't think he ever rode it again, and then ended up selling it. So, I think that thing cost him $1,000 a ride. So that's a little too rich for my blood.
Okay, well, Cameron, it's been a real treat to have you back on the show. I really appreciate it. Now, as we mentioned, you're just on Bloomberg, but for those that have a Bloomberg terminal and want to learn more about you, why don't you just tell people where they can find you and how it all works?
Well, I write regularly for the Markets Live blog, which is MLIV, and then I write a daily column called Macroman, which you can find if you key in NI Macroman, one word. And Kev, if I could just add one last thing. I really appreciate you having me on, and I really appreciate you having me on the first time. My mother passed away early last year. And the last time I spoke to her was basically the weekend that our first conversation was published. So the last time I spoke to her was about our first conversation, and she told me how much she enjoyed listening to it. And and hearing about hearing my perspective on my career as told to sort of a third party. So that's something I'll always remember. So I know this is a little maudlin and maybe a little too serious for a Friday afternoon vibe, but I just wanted to say thanks, and I'll always appreciate that.
Well, it was our pleasure having you on, and it was great that we could do something to help your mother remember you in that way, and it was our pleasure being a little part of that. So thank you for being on the show, and thanks for coming on again, and we'll have you on again in another year's time and find out about whether we can convince you to become a mountain biker or not.
Yeah, that's a hard pass, I think.
Okay, well, you know what we'll have to do. If you're, I'm gonna come up to. You're in Connecticut, I think you told me earlier. I'm gonna bring some mountain bikes, and we'll come by and we'll go out for one, and we'll see if we can convince you if we get you out on the trail.
Bring a road bike, man. I'll take you up some of our local hills. We'll have some fun.
Okay, well, sounds good. Thanks again, Cameron.
My pleasure.
Take care. Okay, Patrick, it's time for Talking Charts.
Let's start off with the top 3 things we were watching last week. And the one thing that was certainly on my mind last week was about those jobs numbers. And you know what? They're not. It feels like with everyone so sure that a recession is here, it's like I just get why are these numbers not worse?
It's a recession in the stock market or in the financial markets. It's not a recession in the real economy. Yeah,
well, at least the way they measure
Patrick,
it.
The answer to your question, though, is that the jobs will be the last thing that goes.
Yeah.
And that'll be what happens. But yet, listen, the reason that everyone is watching it so carefully is because they have to at least stop being so strong, and this was not it.
Yeah. Did you pick up anything? Number 2 was the FOMC minutes. Was there anything that caught your eye?
Nothing really. I do find that we rally into those FOMC minutes. At the very least, people should look at that. It seems to be one of those days that just for whatever reason, we often just kind of levitate into it. It gets really quiet before they're announced and the market rallies into it. And I think we had the exact same scenario.
Yeah. And the number one thing we were watching was no triple bottoms on the Euro USD. And
no such thing as a triple bottom. And thank goodness it actually proved the theory correct.
Yes.
So I can regain my credentials as in my only technical pattern that I actually believe in still holds.
Well, you know what? The interesting part, I mean, we did trade down to a low of almost parity. I mean, it was under 101.
I heard. I heard today. We're on Friday. It actually went pretty close, right? What was the low tick?
The low tick, 1 spot 007.
Well, we're close. We're there.
That's I mean, to me that's a rounding error. That's pretty much parity. So, you know, I mean, obviously, you know, it didn't officially hit parity, like all these, people that want to say stuff like that. But like we went from like 115 in March and February down to pretty much parity.
They don't know how thick your crayon is that you use.
Exactly. If you use a thick enough crayon, it hit parity.
That's right.
But the thing is that it's been one hell of a move. The bigger question is that we'll talk about the dollar in a little bit more in a chart in a moment. But it was definitely a breakdown last week. So this week, I want to just talk about the things we were watching for next week. And the number 3 was retail sales, and like we were saying, the jobs you were thinking could be the last to crack. So, like looking at this data in the U.S. for any hints that the recession cycle may have really kicked in is something on everyone's mind, and therefore I think watching that retail sales is going to be at least noteworthy to just see whether or not it starts to crack.
I did see. I was looking through some of my charts and some of the research that I got, and I saw Bank of America was highlighting the fact that Visa spending on goods has been declining, obviously, over the last few last few months. Yeah. As we've moved from the transition from a goods, everyone's spending money on goods because of the lockdowns and because of COVID, to more service oriented. But last month or last week, I can't remember. I don't know if this is weekly or monthly data. I can't remember. For the first time, we had a decline in service spending on the Visa, and I thought that was interesting because it's showing that that maybe we're stabilizing and that we're not going to get any more. That kind of switch from goods into services is done, and maybe the economy is slowing a little bit. Anyways, we'll see. That's why we're watching, and that's why we have it as number 3 things to watch.
Number 2, if on my mind, has got to be crude oil. And obviously, we had monster volatility. That one day from its peak level to its low level on an intraday highs, 12.5% swing intraday. On a $1 trillion market.
Yeah, so it's the largest commodity market there is.
Yeah, and to have a 12% swing in one intraday in one day is just astronomical volatility. Like, I mean, the margins on crude oil contracts are now like over 25%.
This can all be easily explained, Patrick.
Explain.
I wrote a bullish piece right before there. That's
there you go.
all it is. That's all it was. I
just
thought
washing you out.
I thought I was so smart because I had waited and I had done it, and then I wrote this piece, and then next thing you know, kaboom. No, this didn't wash me out. I bought more, and I hadn't yet bought all my energy equities, so I used that opportunity to buy my energy equities. I love them down here.
Yeah,
I'm a raving Cuppy / Josh Young / name your favorite energy bull in here now at these prices.
So. What I want to highlight is what I'm watching. And to me, look, I've talked numerous times, especially to my own members, about the importance of the 100 level. And we did break temporarily below 100. It kind of poked down below, like turtle-headed below the 100 level a couple times just to kind of mess around with stop losses. It was a liquidity event to the downside. But to me, now it's all about whether they can clear levels, the fib levels around like 105. Like the way I look at it is, and we're trading there right now, this is why I thought it was so important to highlight, because if the bulls can get crude back to 110 or 112 by next week, then it just proves that this was just one quick like liquidity washout. It was like gunning stops, and the bulls are quick to buy the dips. And if that characteristic continues to emerge, then I actually think that this washout could have banged out the bottom in oil. Now, could have is the key word for me. Now, you're already loading up. I'm along already, but I'm not going to be banging the table saying that the next bull trend has begun until we see the bullish price action start to return. To me, the first hurdle is let's see if they can clear 105 with some gusto, get it back toward 110. That would really, I think, repair the chart quite a bit to turn this back to the upside.
All right, that's why we're going to be watching. And what's the number one thing of you're going to be watching?
Inflation numbers.
Oh, yeah.
Like... Are we still going to be,
I don't know. I've gotten, every time I've thought that the inflation was finally going to peak a little, crest, and, I used to be the biggest inflation bull out there, and it's even surprised me. I've been wrong.
Well, I'm making the call right now.
It's going to come in under?
It's going to come in under.
Oh,
absolutely.
I'm
making the call right now.
I like it. Even if you're completely wrong and end up looking like a fool, I like it. You got some balls. But
you know what? The problem I had with everyone making the turn calls over the previous months was it was in a period where almost every commodity was ripping higher. It was huge momentum in all of that. It's not like I get it that it's going to peak in that moment, but like I think that we needed to see. U.S. dollar strength, commodities backing off, things to really start to feel this way in order to really see a potential short-term, crest of inflation. I don't want to be a deflationist and think that this is all going back to zero, but I think that year-over-year peak inflation may temporarily start to roll here.
Don't lie to us, Patrick.
Oh,
You said I don't want to become a deflationist.
Okay,
Of course you
okay.
do. Of course, you're saying that it's not very practical, but it's like, of course you do. Like it's like you don't.
All right, let's change the topic quickly and let's go look at
You don't want
charts.
to go on a date with Kate Upton, but like if it happens, it happens.
All right, so let's hit the some of these charts. So S&P 500. You know what? I find it really interesting. I think that a lot of people are ready to, like I remember this one person published some sort of article that no more pink tickets or something.
Oh,
like,
who's that idiot? That guy's an idiot.
Some idiot.
What is a pink ticket after, anyways?
Yeah, I'm not sure.
What kind
but
of idiot would use that kind of language?
I don't know. And but there's been a number of people that just because the market has stopped going down has made them feel that they want to fade it to the upside. Now, look, there are always big rallies during bear markets. And the question we're trying to figure out, have we seen that turn point where some sort of more meaningful bear market rally could ensue? And for me, we are now going on to 2 weeks off of the low that came in the middle of June. And let's be realistic. The S&P is only a couple hundred S&P points off of its lows. That's pretty pathetic. And the way I would put it, like with a nice thick crayon like this, just draw this line right along here and throw in something like a 50-day moving average. And it's like, for me, until the S&P has cleared 4,000, I think everyone's getting way too excited too soon. Now we got OPEX coming in next week, so as maybe the market stays quiet or pinned maybe next week, and if it loses any momentum and stays below 4,000, we could come into the latter part of July getting hammered to the downside. All I'm saying is it's a little early and premature to be already calling a short-term bottom in this. I think that the bulls have a lot of work to do to repair these charts, and I think the 4,000 level is a nice, clean number to watch.
Okay, I'm not going to argue with you. I like the fact we're on the other side of the trade.
All right, so the dollar index, we talked about that euro earlier. You know what though? It's starting to get parabolic. Now, we talked about these Eiffel Tower formations and these accelerated slopes that occur, and inevitably it leads to a reversal. Inevitably it does. But what will be really interesting to see is whether this final phase leads to some sort of a surprise kind of blow off, or whether this is already where it's going to run out of steam. Wouldn't it be interesting if we just had like the euro just get ripped down to 95 cents and then you just see the US dollar yen make one more big move and everything just kind of capitulates before we see that top? I personally think that this is already, because of the rising slope, inevitably there's going to be a top. But the one thing that I'm watching, does it blow off a top? Like, are we going to get one more rip to that upside?
I don't know the answer to that, but I will tell you that I just scrolling through my Twitter, and I see that there's somebody, a famous other commentator out there that says, quote unquote, nothing can stop the dollar milkshake playing out. And it's not Brent.
Okay.
It's not Brent Johnson. My point is, I feel like we're getting to the point that there's lots of bulls out there. Like, how many times have you heard the inevitability like this?
And let's say, like, there's been a number of barrel eye oil people that were so sure that oil was going up, and the oil just needed to wash them out. Yeah. Like, this markets do this.
You know what we need, Patrick? You know what would really be the last cake in the candle here? It would be a Twitter Spaces. Is the euro going to 80 or just 85? That's what I'm looking for. And then that's the point. I'm just buying all the euros I can.
There you go. I like it. That's good conviction. Anyway, we're going to keep this one a little bit shorter. I just wanted to highlight, like, gold got slammed. Right? Like, that's
again
and
proving there is no such thing as a triple bottom there too.
I don't.
There was.
Yeah, okay.
It was
All
trying
right,
to make
so,
that like triple bottom there.
Yeah, I mean, you could. That's a stretch, but okay. I'll give you this one. I'll give you that one. But what I want to highlight is that we're coming back to 2021 lows, right? Down along all of these previous lows over here. It'll be really interesting to see. For me, the correlation of gold has been to the dollar, which is the dollar up and all cross currencies, including gold, going down. And just the same way that we are seeing a potential blow-off top coming in the dollar, still potentially at higher prices. It'll be interesting to see if that corresponds within days or weeks of a short-term low in gold, and whether gold actually holds the line in these major support lines. Will that lead to buying opportunity? The one thing that I find interesting about gold, Kev, nobody is talking about it. Everyone has basically lost all interest.
That's true. That's true.
There's no buzz. All the gold bulls are lying low. They just they don't want to show their faces to get shamed, and so things are quiet. And sometimes the best buying opportunities are when nobody's looking.
Oh,
and
that is so pithy. That is awesome. We're gonna put that like in your on your Twitter handle.
Oh my God! Don't.
That's
do
like
that.
something smart you said. Someone timestamp it.
The one thing, like you put me on 186 episodes of the show. At one point, I'm going to say one thing.
Well, there's
smart.
more than one, but you're right. It is like we got to just make sure we stamp the tickets.
Inevitably.
Yeah, inevitably. All right, what was it? Is that
yeah? I'll just leave it. Just touching on the 10-year yield. We're back above 3%. I'm dying to find out whether this creates the most classic of patterns of the head and shoulders. Will we see yields reject as they get to this kind of 320, 325 zone and come right back down under 3%? Or do yields punch higher? I'm not calling the pattern yet.
You're just saying it could occur this way. It looks like it is. It's because you're a deflationist at heart. You think this is going back to zero.
Well, yes. I mean,
all right. At least you're honest about it. That's what I like. At least you're honest about it.
Anyway, that's all I've got for today's talking chart. So let's go on, bud. So let's get to skin in the game, and you started off on the right up. And you know what? It's like I chose a number because I wanted to be on the other side, but you took the right side. You made the right call. What can I say? So
tell people what it was and how it worked.
I'm going to let you do how it worked because you made the rules. I'm still trying to figure it out myself. But the thing is that we chose the 375 level on copper futures on the August contract, and we were just doing the over-under. I thought I picked a good level, but copper just had its face ripped off.
Yeah,
unbelievable.
Well, yeah,
like
I kind of face ripped off implies that I guess you can lose P&L. Like it doesn't matter. I always think face ripping off is when someone's short and then they get their face ripped off. But you're right. You could have been long. It was straight down. It wasn't even close. You were too greedy. Yeah. You expected me to be too bullish.
I'm sorry. You had the first pick. I had to take the other side.
No, but you set the 375 too high.
Well, I needed to give because I knew you had a bullish tilt, so I needed to give myself a little bit of a cushion.
Okay,
and you did the right thing, and you picked me off.
Okay, so let's talk about this. Skin in the Game is our weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager, and the other guy chooses which side of the bet he wants. Every wager needs to settle by next episode. But listen up, folks. We have changed the rules of the game, as Patrick talked about. We're going to play a match to 100 points. And it looks like the last one was 3 points that I just won off Patrick. The loser of the match will take out 3 lucky or unlucky, depending on how you think about things, Market Huddle listeners for a dinner where they can grill him about why he had so many bad calls. And it's most likely going to be both Patrick and myself. But we can, whoever loses is going to pick up the bill. Each week, Patrick and Kevin will be able to bet anywhere from 1 to 10 points on each wager. Once someone hits 100, they will win the match, and the loser needs to start figuring out restaurant reservations. Lena's going to somehow pick the 3 Market Huddle listeners randomly. We'll figure out those details as we get closer, but the pool will definitely include those listeners submitting no stupid questions and those sending us side effects. Okay.
Nice.
So
all right,
I gotta think up something that we're gonna do.
Yeah.
Okay, let's do the dollar.
Ooh. The Dixie? Or you want to go to one of the cross currencies?
Let's just do the Dixie.
All right.
And I'm going to just keep it simple because this is your style. You like doing this. Up or down from here?
I'm going to take down.
Oh, you bugger. Oh, gosh. Okay, well, I'm not going to bet very much. So that's it. That's our bet. So you'll start with 1. You want to, that's the original one. I'm not going to raise.
I want the 3 points back.
Well, I'll tell you what. I won't just bet 1 because that's kind of lame. I'll bet 2 just to make it fair to give you a chance to get back in there. So 2 it is.
What do you mean? Who gets? Okay.
Because you raise, and I can go. I don't have to.
Okay, fine. Take your 2 points.
Okay, so the Market Huddle leaderboard right now. It's Kevin is winning 3-0. We're now betting on the DXY for next week, next Friday. Patrick is chosen down. I've chosen up. It's a whopping 2 points that we're betting. Patrick obviously chose the way that I wanted to go, which means, folks, Patrick and I both think it's headed lower. You know what to do.
Just go.
You know what to do. You know what to do. All right. No stupid questions, Lena.
Come save the day, Lena.
Okay. Hello, you most magnanimous of market podcasting participants who I love so very much. My question, looking out on the crude oil curve, the 2025 contracts are trading in the $65 area. If one agreed with Cuppy and you and wanted to short political sanity by going long oil for a few years, why would one not buy those 2024-2025 contracts that are almost at a 50% discount and simply wait? I know liquidity could be an issue, but I am a tiny retail trader, and I'm pretty sure I could dump the handful of contracts I'd own if I needed to. So besides liquidity, why not buy 2025 oil and just hedge it at the front of the curve if need be? Thank you.
Well, okay. If you want to,
I just have a chart here of this is the December 2025 trading at $70 basically. So he's just basically saying, why not just go out here and grab that future contract? I mean, that's the part of trading term structure, isn't it?
And that is what Cuppy and all the guys are doing because they're assuming the curve's going to eventually move its way up. But the part of the question that kind of scares me a little bit is hedge it at the front of the curve if need be. That's the part that's scary. You get into a situation like with the war, when we saw the war, the front of the curve exploded.
Did you say war or war?
The war. Like with Ukraine war. I don't know what.
I don't know what I heard. I heard something different.
You saw that it blew out. The front of the curve went straight up. And so you can't. There in markets, there's nothing for free. Like you can't go and be short the front end of the curve and own that and think you're all hedged up because you're not. The reality is that you're promised to deliver something that you have no ability to come up with except for by buying it back. So there's no real hedge. But at the same time, if you wanted to assume that the curve was going to stay the same, if you bought that December 25 contract and nothing changed between now and then, and the 3-year contract was still at $65, but the front month contract was now at 110 or wherever we are, your contract would slowly rise in price as it got closer and closer to time. And that is the carry trade that a lot of the crude oil bulls are doing and assuming that's going to be the case. The other thing you need to be aware of is that a lot of people do this on margins. So, yes, you can buy this and maybe you're correct, but what if it goes to $30? In the meantime, you just need to make sure that you have the wherewithal to stay with it.
It's a good trade, but it's got a long time horizon, and you got to really have conviction that it's going to play out, and you have to hold it through, right? Like because this is like you were saying, we had huge movement as an example, let's look at that December 2025 contract again. Yeah, it did go from $52 to 76, but it went from 52 to 76 in the same window that that spot went from 50 to 130.
Yeah.
Right? Like the point being is that you're playing a long game. You're playing something that needs time to play out, while the volatility that you're seeing at the front of the curve is not going to manifest itself the same way farther out on the curve this way.
Okay, next question.
Hey, Patrick, Kevin, what two pieces of information, economic, social, or political, do you wish you had that would give you more confidence investing in the next 9 to 12 months? Thanks.
That's a great question. Patrick, you start.
I'm going to say, what is the U.S. dollar going to do in the next? And the second thing I'm going to watch is what the U.S. dollar does in the next.
That's not really fair, because that's not economic, social, or political. That's you're asking for a market price, which to me is not the same.
No, because so let me. Well, economic. I mean, ultimately, the dollar's trend is going to be driven by, you can say, monetary policy and interest rate differentials between different countries and things like this. So, I guess you can extrapolate from my view is that obviously the Fed's willingness to tighten as aggressively as they has been what has been one of the key drivers for the great U.S. dollar strength. And ultimately, if Powell has to pivot at some point, then suddenly that what was been a divergent interest rate policy from, or at least from this rate of change, would suddenly converge, and that could be a catalyst for turning the dollar. And I think there's huge implications for that. Is that good enough?
I guess so. I'm going to borrow one from Cameron. I think on the political side, if I knew what was going to happen in the Russian-Ukraine war, that would obviously dictate a lot of my investment decisions and could make things much easier. Like if you knew tomorrow that a month from now that the Ukraine conflict would end, there's some pretty juicy, easy trades there. So I would say that. And then the other thing I would argue is that in the past, if you look, I would say maybe since China started the WTO, but maybe a little after that, but definitely probably from 2004/5 on to maybe 2016, the one indicator that everyone wanted to know was what was China's economy going to be like. Because they were driving the bus. They were the ones that were buying all the iron ore. They were buying all the copper. And so if you knew what China's economy was going to do, you could answer a lot of questions. I don't think that's as important as it used to be, but it's still a really good one. And I would say that if I had to know something, I would be like, when does China and how much do they stimulate, or what's the Chinese economy look like in the next 9 to 12 months?
So I want to push back on your first one. And because
the Russia-Ukraine,
because I think you can't put the toothpaste back in the tube on this one. That even if the actual hot war of guns firing stopped, the new changes in supply chains, the politics, and all of these different things would never go back to normal.
So I don't disagree with you at all about that. But I definitely I'll take the other side of to think that it's not going to affect the price of the euro. It's not going to affect the price of natural gas delivery in Netherlands. All those things.
Sure, I think I don't. Well, you think suddenly everyone's going to start buying Russian gas just because the bullets stopped flying?
Yeah, they need it. 100%.
Yeah, but I think they're going to be buying it in rubles anyway. It's
no, but they can't even get it right now. They're worried they're going to not get it. It's going to change everything. It's also going to change that your.
I think there's something
foreigners' willingness to buy Europe. Like, tell me, would you go?
I think there's a much bigger fourth turning thing going on in the world.
Gosh. Did you?
Yes, I just did. I just did do that. I think there's a bigger thing going on, and and things are not going to go back to normal just because the hot war ends.
But that's not what I'm claiming. I'm just saying that they're going to change prices.
Okay.
Like, it's going to change prices, and that's the easiest one.
All right.
But anyways, we'll let it go, and we'll pretend that you didn't say fourth turning. Okay, next question.
Hi, Market Huddle team. Fan of the show and Patrick's other podcast, Macro Voices.
Oh, God. Patrick, do you have another podcast?
I've been cheating.
Yeah. Oh, God.
I had a quick but stupid question about treasury yields and commodities as they relate to equities. Many internet keyboard warriors have seen the price action in the recent months and inferred that yields such as the 10-year and stonks are inversely correlated, particularly the NASDAQ, or dare I say, ARKs. How do you address those who theorize that a market bottom is in as treasury bonds continue to rise, yields continue to drop, and similarly commodity prices, now crude oil included, have seemed to collapse? Is inflation now suddenly over since meme stonk 69 on Wall Street Bets said so?
For sure. You got to listen to anyone called meme stonk 69.
Yeah, that's
Elon.
that's instant street cred.
I will tell you one thing, that all these relationships that we see in terms of like 10-year yield versus stocks, and specifically growth stocks, they occur and they stay until they don't. And I was just looking actually at a chart that was created by Morgan Stanley, and what it had was the Canadian dollar, the loonie, versus oil. And for the last decade, they've been on top of each other, meaning that if oil goes up, the Canadian dollar goes up or down in terms of the US dollars, and this relationship's worked really well. And then what happened in 2020? What was it? Basically, this year, it completely broke down. And just because something has worked in the past doesn't mean it will continue to work. And this is what happens. You get these relationships, and by the time everyone's figured them out, they stop working. So just be careful about assuming that because this correlation has worked in the past, that it's going to forever and always work.
Okay.
That's my kind of feeling on that.
But you know what? Generally, I think the point here is that that a lot of the unprofitable techs have been hammered because rates have been going higher.
Yeah.
And I think that really the bigger question here is that if we have seen yields put in a short-term top, God forbid that there's a head and shoulders pattern on that 10-year.
Boy, if that happens, there's going to be somebody that's going to be pretty happy.
The question. Does a yield coming off suddenly take the pressure off of that bear market selling that's been?
Oh, and I think it is. I agree, Patrick. I think it has. I think that's why we've rallied over the last little while. And in fact, I think there's somebody out there, like a big account that was long commodity / energy, short NASDAQ, and has been taking it off for this week. I really do feel that way. There was a day there when the energy just got. It was offered in size, and even though the stock market felt bad, the tech stocks had a bid to them.
Right.
All right, here we go.
All right, last question.
Oh, you guys didn't talk about meme stonk 69.
I did. It's Elon.
Clearly, he's like a 16-year-old.
Oh well, then you should definitely listen to him
meme
then.
stonk 69. Anyways, okay, last question. I don't think it's a question. It's more of a statement. I'm going to need to have the Lord of Crayons debunk or prove that there is such a thing as the vomiting camel formation, and then tell me what the retracement bottom is for the asset which shall not be named. I think it is $8,000.
Oh, I like this technical analysis guy.
Well, first of all, there is the vomiting camel formation is the bedrock of technical analysis. It is.
It's the first thing they teach you at the school.
Exactly. You need to know the vomiting camel formation. It's
like Shakespeare. Like when you're studying how to write, you have to learn Shakespeare. When you're studying how to do technical analysis, you have to study this.
It's almost as strong of a pattern as there's no such thing as a triple bottom.
Yeah.
And but you know what? I do not know whether this particular chart pattern was the correct one to have applied the vomiting camel formation.
Oh.
But the spirit of it is there.
Okay.
Anyway,
the asset shall not be named. Is it going to 8,000? Is that the bottom of the vomit?
Well,
Oh, that's definitely a camel to me.
well the one.
There you go, guys. Say no more. Lena's already proclaimed it a vomiting camel formation. It's over.
It is. It's
That's what it
over.
looks like.
It's. Unfortunately, the camel's already had several bowed heads of vomit, so it could particularly bottom. But anyway, definitely all of these consolidation zones from its 2019-2020 zone are on the table. Now, we did see a short-term bottom in Bitcoin. It's not going to be a shocker. See some reactions like we are seeing in all markets where this crawls back to 25,000. I wouldn't get excited about the long side if it did. But if the bear market was to continue and liquidity was a stress and the dollar continues to run, then a move down to those 2019 and 20 kind of highs down in that zone are on the table. It's so 8,000 could happen. I don't know if it's my highest conviction idea, but when I look at that chart, there's not much reason to believe that
that's a load of gobbledygook. Lena, since you proclaimed it definitely looks like a camel, are we going to 8,000?
Sure.
There we go. I like it. Now that's how you make a call.
Forward the hate mail over to Lena.
Yes.
No.
Yes.
It's
send me
not
all
her
the hate
fault.
mail if you want.
She's just calling the technical pattern that she's seeing. She doesn't even know what that is. You can't get mad at her.
And you know what? If it goes down there, she gets the credit. It won't be me because I just I wishy-washied my way through the entire commentary.
Yeah, you gotta pick a side and commit.
And
you know,
Lena, you got to read the last sentence here, and you got to do it in the right voice.
Yeah. This listener said, also, I just hang on for when Lena says hello. She has the best voice in radio. Thank you.
It is a really good hello. All right. Anyway, Lena, where can they submit their questions?
So if you have any questions for Kevin and Patrick, please submit your questions to nostupidquestions@markethuddle.com.
All right. Thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give us a follow at the Market Huddle on Twitter. You know the drill. Patrick, where can they find you? You
can find me at bigpicturetrading.com or on Twitter at Patrick Ceresna.
And I'm on Twitter at Kevin Muir, or you can check out my newsletter at themacrotours.com. And listen, we can never have too many friends. Bear market, bull market. We're just happy to spend some time together on this crazy ride. So now stick around for the after show. All right. So we got to do Chicken Man beer.
Oh no, what did we rate this last time?
No, you know what? This is a big faux pas because now what happens is that if any of our listeners go back to the episode where we featured the other one and they go to the scoring and they find out we have spectacularly diverged from our scoring from one episode.
You know what? Yeah, I can easily explain that.
Circumstances are different.
No, not only that, our palate has become more sophisticated.
And we went through COVID.
Yeah.
You know,
yeah.
there's
a lot of
factors
things that have gone on
in play.
here.
Now it makes
sense. We're much older now.
Gotcha. Okay.
By the way, I'm wondering, I actually have a question. Well, let's do the beers, and then I have a question for you about COVID specifically. Lena, what do you rate it?
I'd rate this. This is pretty good, 7.8.
Okay, I'm going to give it an 8.5, mainly because I love the Chicken Man logo.
So you just get fair enough.
Okay.
Fair enough.
You don't have to have you just have to have a reason.
No, I'm just going to give it an 8.1 because it's a good beer. I like it.
It's a good beer.
Okay,
it's a good beer.
So I have a question for you guys. So I got COVID. When was that? 3-4 months ago. I was wondering how long my super immunity lasts. How long before I'm going to get it again? Because there's
we're 3 months.
We're in a wave right now, right? And it's going everyone's getting it. We're ripping through again, and so 3
months I think is super, but you shouldn't get it more often than I think you got a 6-month window.
Well, I don't know. You should see me. I lick the handrails on the subway, though.
Even now?
That's impressive, Kev.
Wait, you take the subway?
Yeah, I take the subway. So what do you guys think? How long before I get it again?
Well, I mean,
you managed to go 2 years without getting it at all.
I
so,
know,
like,
I was good.
You're like a
doing
hermit.
I was doing really well. No, I went a little bit of things.
but does your immune system get compromised if you have a concussion? Like, does that have any
I don't
factor?
know, but I blame most of my stupidity on that nowadays, though. I'm doing something dumb. It was a concussion.
At least you have an
Yeah, it
excuse.
was a concussion. I shorted more into that limit up rally. Oh, that was a concussion. Oh gosh. Anyways, did you guys have a good? I guess last weekend was our long weekend, right?
Yeah.
Did anyone do anything exciting?
No.
Luke and I took our 2.5-year-old niece to Ripley's Aquarium downtown for the first time.
Oh, it's actually not a bad aquarium, don't you think?
It's not bad at all.
Yeah.
It was really, really cool. It's just I had gone to the Georgia.
Oh, that's in Atlanta. That one's awesome.
Yeah, I think that's if not the biggest, or
I think it's
one of the
I
biggest.
think it's the biggest in
the
North
world.
America, or is it the biggest in the world? They have the whale sharks, right?
Yes,
And those are
yes.
spectacular.
Oh, it's amazing
Yeah.
there. You can spend all day there. So in my head, I was like, that's what I had in
Ah,
mind
yeah,
for
no,
whatever
you just-
reason. And then I went, I was like, oh, this is like a
It's like
Canadian version.
no, you know what? Ours isn't bad, but you went to a really great one. The other one that's
Yeah.
good if you're an aquarium fan, because we take the kids everywhere. We've been to like the Shed one in Chicago. I can't remember if it's one. Anyways, anywhere we are that there's an aquarium, we even drive out of our way to go to it. Like one time on the way to Florida, we went to the Atlanta one.
Yeah.
One of the ones that I like best, and I liked it even better than the Atlanta one. The Atlanta one, to me, that one tank is really impressive with the whale shark or whatever it is.
The biggest one, I think. It's like
It's
huge, right?
crazy.
And you can go like diving in it or whatever, or you can go scuba in it.
I'm not
or
going to do
whatever.
that. But the Monterey one is awesome as well. So if you're ever in California, Lena, and you like aquariums, make sure I guess it's closer to San Francisco. It's really good, and it's really it's not quite as impressive because it doesn't have that big huge tank, but it's still really well done. And they got all sorts of seals out there, and I kind of like the seals.
It was just nice to see, a little one experiencing something for the first time.
Yeah,
right?
no, it is nice
So
that way.
that was great.
Well, it's terrific. Yeah. And any good shows, Patrick? You watch anything good shows lately?
Oh, absolutely not.
Nothing.
No,
I literally just don't watch things.
he doesn't have a TV.
Well,
Actually,
he's
I
like
do.
the kids.
No,
He's like the
I
kids.
do have
He has a
TV.
TV that's like a placeholder. in his
Exactly. I literally only bought the TV because it makes the living room look normal.
It's non-functional.
You know
It's
what?
just a
I
TV.
never turned it on, Patrick. I don't even know if it worked.
It doesn't. It's like one of those TVs.
Why would
see
you
at
turn it on
IKEA.
when you can go out and have fun and go drink for the 99-cent juice boxes or whatever? They sell little 99-cent, 95-euro juice boxes that are wine.
Did you get the fresh orange juice from the?
So everyone
grocery
went on
store?
about the fresh orange juice. I don't know if I was there the wrong time. The orange juice wasn't that great. Like I love Lisbon, I love Portugal, but I'm a seller that everyone goes on and on about the orange juice. Florida's got better orange juice. I listen. I'm standing by that. I'm standing by that. I don't care. It's probably the only thing that Florida does better. But anyways, gonna get in trouble for that.
Send the hate mail to Kevin at.
I'm just kidding. I couldn't resist. It's kind of teed up there. No, I didn't find the orange juice that great. Did you? You really loved it? I'm telling you, it must have been the time of year. I must have missed it.
Well, we were there in August last
Yeah,
year.
I think
Awesome.
I think that it takes a little while. That mine are like that. You need them to. Like I think that the season's a little bit later.
Know what makes the orange juice taste better?
Vodka?
Some Prosecco. Yeah.
Some alcohol, any kind of alcohol.
Suddenly, this is the best orange juice I've ever had.
Well, I knew I was in Patrick's place when I looked at the coffee table and it says liquid assets. And they are not the
my
kind that you
gosh.
sell on the market. It might be the kind you drink.
Oh my goodness.
It's actually called liquid intelligence.
Oh, is
but
that what it
anyway,
was?
goes on.
Liquid intelligence.
I got it wrong. Sorry.
It's one of the most important bar books, buddy. When you're mixing your cocktails,
Patrick does
you
have
gotta,
like a full-on little tiki bar little thing going on there, and I don't know what it was. I skipped that as well.
Did you skipped it?
Yeah,
oh my God.
you know what? You know me. I'm not as much of a drinker.
I've got like 11 different rums in there. It's
what now?
Yeah, he's not an alcoholic.
No, he's not. He's a social drinker. He's just social all the time.
He's a great bartender.
Is he? I didn't know that.
You'll never have an empty glass in your hand if Pat's around. Pure pressure Pat comes out as soon as alcohol's introduced.
Oh. It's the Eastern European in me. Like it's like drink some more. Anyway.
And so, are you already well into the night now, Patrick?
Well, yeah, it's out here. It's.
Did you not hear it?
Yeah, no, I can hear it. Yeah, no, I can hear it. It's. And so, what is your drink of choice while you're there?
Well, I'm here right now.
Yeah.
You know what? I've been going on a bit of a wine binge.
Oh.
It's like
he's becoming a wino.
No, but you know what? It's honestly like I go like I love beer. We obviously feature a thing, but I just needed a break from sessioning beer, like just like where I'm just drinking like 6 to 8 beers in a night or something. I don't mind having a nice beer with dinner and enjoying that stuff, but anyway, I'm in a wine phase right now.
Okay, so you're drinking wine. What are you drinking?
Whatever's on sale.
Well, you know,
€3.
Cuppy thinks that the best wines in Portugal are in boxes. And he was not,
you know what?
He was not being sarcastic, and he is a little bit of a wine freak. So
Did you try boxed wine when you were in Portugal?
He didn't. No, but he did not say in Portugal. He was in the Azores Islands of Portugal, and I'm going there next week, and so I think I'm going to honor Cuppy by getting a box of wine.
Nice.
And I'm going to test out this theory.
Test this here, and listen. I don't think you can do it by just testing one box. I think you got to try like a lot.
Like at least
of them.
3.
I'm thinking 5, maybe 10.
You can do it, Pat.
You can do it, buddy.
You can do it.
And I hear that the first one is not like to really get the wine. You got to get right to the bottom of the box. Ooh. The first glass isn't good.
Ooh.
Really, guys?
Like a lot of fun.
All right, that sounds like a great idea.
We need a full report when you do your wine tasting.
I must say, I'll tell you one thing, Patrick. I am obsessed with this Madeira Island. I don't know how to say it, but it's south of the Azores. How do you say it? I'm going there, and I'm going to figure it out, and I'm going to go. And the reason I love it is because it was in this book, Malibu Rising, that I loved. And she basically decided she wanted to get out of Malibu, and she just went and surfed there. And I've decided that's what I want to do. I just want to sit there. I want to surf in the morning and then trade in the afternoons. I've already got my pseudo retirement planned out.
I love it.
Okay, on that note, everyone have a great weekend.
Yeah,
have a great weekend, everyone.
And have a good one, and we'll to be continued.
Yeah, have a good night, Patrick. Stay out of trouble. Don't do too many things that are. Just remember, you no longer have, because you spend so much time in Portugal, you no longer have diplomatic immunity.
Yes.
Usually when you're just there for a week, you could go, you know what, I'm getting arrested, but that's okay. They'll send me home. But you're almost like Portuguese now. They're going to keep you.
Damn it.
Take care,
Damn
everyone.
it. All right, take care. All right, cheers.